Picture a frothy cappuccino with bubbles almost spilling over the cup. This might be the best way to describe the current US stock market. As of August 2024, the market has shown signs of overheating. Many investors are worried that it's about to collapse. Record highs have become the norm, but is this sustainable? The S&P 500 and Nasdaq have reached new peaks, driven by tech stocks and speculative buying. Yet the economic fundamentals don't seem to match this euphoria. Inflation is high and economic growth is slowing down. Could this be the calm before the storm? There's a growing concern among analysts that we're in a bubble. A bubble occurs when asset prices far exceed their intrinsic value. When bubbles burst, they can lead to significant financial losses and economic turmoil. This has happened before, and it could happen again. Investors are on edge, wondering if they should sell or hold. Fear of missing out, or FOMO, drives many to keep buying even as warnings grow louder. Let's dive deeper into why many believe the market is in a bubble. One of the biggest signs of a bubble is irrational exuberance. This term, popularized by former Fed Chairman Alan Greenspan, describes an over-enthusiastic market. People buy stocks not based on fundamentals but on speculation and hype. Think of the dot-com bubble in the late 1990s. In today's market, valuations are sky-high. Companies with little to no profits have market caps in the billions. For instance, tech startups and meme stocks have seen meteoric rises. This kind of speculative buying inflates prices beyond logical levels. Another sign is the surge in retail trading. Thanks to apps like Robinhood, more people are trading stocks than ever before. While democratizing finance is good, it also means many inexperienced investors are making risky bets. High trading volumes and volatility often precede a market correction. Lastly, the rise in margin debt is alarming. Investors are borrowing money to buy more stocks, amplifying their gains, but also their losses. If the market turns, this could lead to a cascade of selling, further driving prices down. These factors combined suggest we might be in bubble territory. History has a way of repeating itself, especially in financial markets. Several instances show the market being artificially boosted. The 2008 financial crisis is a notable example. The Federal Reserve intervened with bailout packages. During COVID-19, unprecedented measures supported the economy. The Fed slashed interest rates and injected trillions. This liquidity boost helped the market recover quickly. However, these measures are not without consequences. Artificially boosting the market can lead to distortions. The Fed's upcoming actions. All eyes are now on the Federal Reserve. There's talk of an interest rate cut as early as September 2024. The Fed's primary goal has been to control inflation, which has been running hot. Raising rates has cooled down the overheated economy, but it also has implications for the stock market. Higher interest rates have made borrowing more expensive. This has dampened consumer spending and business investment. For the stock market, it has meant lower corporate profits and reduced investor enthusiasm. Stocks, especially high-growth ones, have seen significant declines. Moreover, higher rates have attracted investors to safer assets like bonds. This shift has reduced the demand for stocks, putting downward pressure on prices. The anticipation of a rate cut has already caused some market jitters. Investors are adjusting their portfolios in preparation. The Fed's decisions are always a balancing act. Tightening too quickly can stifle economic growth, while being too lenient can fuel bubbles. As we approach September, the market will be watching closely. The Fed's actions could determine whether the bubble bursts or deflates gently. Simplifying market jargon. Understanding stock market jargon can be daunting. Terms like irrational exuberance and quantitative easing might confuse many. Let's break down some of these concepts to make them more accessible. Irrational exuberance refers to overly optimistic market behavior. It's when investors keep buying, driven by hype, rather than fundamentals. This often leads to bubbles. Quantitative easing, QE, is a policy where the Fed buys assets to inject money into the economy. It's like giving the market a shot of adrenaline. Another term is margin debt. This is money borrowed to buy stocks. While it can amplify gains, it also increases risks. If the market falls, investors have to sell assets to cover their debts, accelerating the downturn. Understanding these terms helps in grasping market dynamics. By demystifying these concepts, we can better navigate the financial landscape. It's important for all investors, whether seasoned or new, to understand the basics. This knowledge can help in making informed decisions and avoiding pitfalls. Conclusion and viewer interaction. The stock market is a complex and ever-changing entity. Currently, there are many signs that suggest we might be in a bubble. From high valuations to speculative buying, the warning signals are there. History shows us that artificial boosts can lead to distorted markets, and the Fed's upcoming actions could be pivotal. As we navigate these uncertain times, staying informed is crucial. Keep an eye on market trends, understand the jargon, and be cautious with your investments. The market might be frothy now, but being prepared can help you weather any storm. We'd love to hear your thoughts. Do you think the market is about to burst? What are your investment strategies in this volatile environment? Please like and subscribe to Express Econ Finance Insights for more updates. Leave a comment below with your insights and questions. Let's have a discussion.